Welcome to the deep dive. Today, we are undertaking a deep exploration of one of the most ambitious companies in modern American finance.
Truly one of the most ambitious.
SoFi, or, social finance. Our mission is really to trace its path.
Right.
From this tiny idea about student loans born in an MBA classroom to becoming this FinTech super app that's now a real competitor to Wall Street.
It's a fantastic story of disruption, but what people often miss is just how revolutionary that starting point actually was. The whole thing kicked off with a deceptively simple question.
Asked by 4 students at Stanford's Graduate School of Business back in 2011.
That's the one.
And that's really the core of the origin story, isn't it? The Stanford question.
Mm-hmm.
Why is borrowing money for education, which is statistically one of the best investments you can make, why is it so inefficient, so expensive, and just so confusing?
Exactly. And that one question, it just strikes at the core flaw of legacy banking in that whole space. It recognized that the system wasn't built to, support good future outcomes. It was built to mitigate past risks.
And that realization just snowballed.
It birthed a company that would completely redefine how vertical integration works in digital finance. So today, we're going to give you the shortcut to understanding all the strategic moves that turned them from this niche lender into a financial powerhouse.
Okay, so let's unpack that. The original philosophy, education as an investment. Before SoFi, the lending landscape was, as you said, just bureaucracy and confusing pricing.
It is a mess.
So for traditional banks, what was that one critical, fundamental flaw in how they looked at a student borrower?
The main problem was their risk assessment. I mean, that was it. Traditional banks were just stuck
Stuck how?
relying on these legacy, backward-looking credit metrics, mostly the FICO score.
Right.
So they were looking at your past financial history, which for a 22-year-old student is what? It's minimal, sometimes non-existent.
So everyone just gets lumped together with a high interest rate.
Pretty much. They had to default to these high, undifferentiated rates for everybody.
Okay, so if the past wasn't a useful predictor, SoFi had to invent a way to evaluate the future. What was the innovation they came up with?
They did a complete philosophical flip. They proposed pricing loans based on future earning potential.
A predictive model.
A predictive model, exactly, instead of just historical credit. And this was really unusual in the early 2010s, even compared to early digital lenders like Nubank in Latin America.
So how did they quantify that future earning potential without it just being a total guess? What data were they looking at that the big banks were just ignoring?
That's where the real insight was. They didn't just guess. They integrated very specific data points.
Like what?
Like the applicant's major, the specific university they went to, its graduation rates. And this is crucial if they already had a job offer and salary lined up after graduation.
So they were building a much smarter risk profile.
A highly sophisticated proprietary one. Their algorithm understood that a Stanford engineering grad with a job at Google is a fundamentally different risk than, a student with a weak credit history in a field with lower earning potential.
That makes so much sense. Filtering for success based on real-world signs, not just a 3-digit score. And their initial launch mechanism was so clever, the alumni-backed model.
Oh, it was brilliant for building that early confidence. The idea was that students would get financed by alumni from the same school.
Creating this little ecosystem of trust.
Exactly. A lending system anchored in trust and that future income prediction. It lowered the risk for investors, and it got lower rates for the borrowers.
And the success was immediate. By 2012, they'd launched one of the first big student refinancing programs in the U.S. The sources say regulators were, confused but curious.
Well, yeah, they were confused because SoFi was proving with data that banks weren't the only ones who could manage large, secure lending portfolios. They showed that a data-driven, community-focused approach could offer better terms and just bypass the old gatekeepers entirely.
And success like that always demands more ambition. If you can disrupt student loans, the next question is obvious.
What else can we disrupt?
Exactly. What else in the financial lives of these high-earning but still cash flow stressed young professionals? And that's what really drove that super app vision.
Precisely. And they moved with incredible speed. I mean, 2014, they were already expanding way beyond student loans.
Right into personal loans, mortgages.
Home mortgage refinancing, wealth management, financial education. It wasn't just, stacking products. It was a fundamental shift in their identity.
They weren't just a lender anymore. They were positioning themselves as a lifestyle brand.
Yes. A full-spectrum financial lifestyle brand. And while you see similar goals in companies like Revolut in Europe or Paytm in India, SoFi was laser-focused on solving what they called millennial financial pain points in the U.S.
High debt, high cost of living, complicated path to building wealth.
All of it.
And that whole strategy was summed up in their motto, get your money right.
Yeah, and that frames the relationship differently. It's not debtor-creditor. It's a platform trying to improve your financial life.
A holistic approach.
But the real reason they could pull this off, this massive product expansion where so many others failed, was their infrastructure.
Right. So the motto, get your money right, that's great for marketing, but you can't execute on that without some serious tech. So is the real secret under the hood. Let's talk about the engine room SoFi's tech.
Absolutely. Their true strength, their secret weapon was infrastructure. They knew you couldn't build a 21st century financial institution on 20th century tech.
So they started fresh.
From scratch. They built a modern cloud-based architecture, which gave them this agility that was comparable to, the youngest, fastest fintechs in Asia. They weren't fighting decades of old, clunky, expensive legacy systems like a Wells Fargo or a Chase.
So what did that new architecture actually unlock for the consumer? Give me a concrete example.
Speed and scalability. We're talking about things like automated underwriting and real-time data processing.
Which means?
Well, for a traditional bank, a complex application like a mortgage refi could take weeks.
Right, with all the human reviews and slow systems.
Exactly. So FI's machine learning risk analysis and automated underwriting meant that for many standard loans, their algorithm made a decision in under 15 minutes.
That speed is the whole competitive edge right there.
It is, and that robust infrastructure was the foundation for everything they did later.
Yeah.
Launching savings accounts, building a trading platform, offering crypto. All of it was possible because of that tech stack.
It let them iterate and absorb complexity without breaking. But speaking of complex, let's talk about 2017, a moment when that whole structure was threatened. We have to cover the leadership challenge and strategic transformation.
That was a critical moment. The internal cultural problems that led to the CEO's departure. I mean, that's the kind of instability that usually kills promising fintechs.
For sure.
We've seen startups in Brazil, India, the Gulf. They just implode at that stage. Loss of confidence, internal chaos, and it's over.
But SoFi didn't collapse. They did something pretty rare. They executed this brilliant clinical rebuild. They brought in Anthony Noto.
Former CFO of the NFL, COO of Twitter, a Goldman Sachs exec. A very unusual resume.
Yeah.
Noto's arrival wasn't about flashy marketing. It was about injecting institutional maturity and operational discipline. He sharpened the mission, focused heavily on execution like you see in global leaders like DBS in Singapore, and he stabilized the culture but kept that disruptive spirit.
And that stability let them enter their most aggressive and strategic phase.
It did. Which brings us to the biggest game changer of that whole era, the acquisition of Galileo.
Right. So why was buying a B2B infrastructure company so brilliant for a B2C consumer lender?
This is where SoFi really separated itself from almost every other U.S. fintech. Galileo wasn't just a company. It was the essential payment processing engine, the infrastructure layer for so many U.S. neobanks.
You're talking about Chime, Robinhood.
Chime, Robinhood, many others. You can think of it like the M-Pesa backbone in East Africa. M-Pesa isn't just an app. It's the platform an entire financial ecosystem is built on.
So by buying Galileo, SoFi stopped being just another challenger bank.
And instantly became a foundational utility provider to other challengers.
Wow.
They bought the highway their competitors are driving on. It's similar to Stripe's influence in commerce. It gave SoFi ecosystem influence, let them integrate faster, and crucially control their own cost structure. Just enormous future potential.
Okay, so they buy the infrastructure. Then they take the final two steps, going public in 2021.
Shifting from disruptor to institution.
And then the ultimate move,
Yeah.
getting that full U.S. banking charter.
Which brings us to their contender status. And you cannot overstate how difficult this is. Getting a full U.S. banking charter is one of the hardest achievements for any fintech globally. It instantly legitimizes them against the big four.
So beyond the prestige, what are the immediate tangible financial advantages of that charter? How did it change their business model?
It let them drastically lower their funding costs. That's the main thing.
Go.
Before the charter, they had to borrow money on the wholesale debt markets, which is expensive, to then make loans to consumers.
And now?
Now, they can accept consumer deposits and use that cheap deposit money to fund their lending.
Which translates into...
Higher net interest margins.
Yeah.
Or IN. It's basically the profit a bank makes.
Right.
By switching from expensive debt to cheap deposits, SoFi's NIM shot up, giving them sustainable profitability and a huge competitive edge on pricing.
That's what makes them a true contender against Wells Fargo, Bank of America, and Chase. They're not just a digital lender anymore. They're a vertically integrated bank that owns its tech and its payment rails.
And if you look at their current offering, the Super App stack, they're a true hybrid. Bank, investment platform, payments network, education hub, mortgages, credit cards, high-yield savings, stock and ETF investing, crypto, robo-advisors, employer benefits. It's a huge, simplified vertical stack for the U.S. consumer.
Which brings us to the global comparisons. We often mention peers like Revolut, Nubank, Paytm. Why is SoFi structurally unique in that landscape?
It really boils down to 3 structural advantages that very few others have, especially in the U.S.
Okay, what's the first one?
First, the full U.S. banking charter. That level of regulatory clearance is exceedingly rare. Second is the vertical integration. They control the customer experience, and they own the processing infrastructure through Galileo.
They control the money and the pipes.
The ultimate control, yes. And the third is brand cohesion and agility. Unlike the old incumbents, SoFi markets itself like a responsive tech company with a clear mission.
And that combination gives them resilience and better margins.
And the agility to just keep out-innovating the slower, older banks.
So looking ahead, what's on the roadmap? What should we be watching?
They're pushing hard into employer-based finance, offering financial benefits through corporations. Huge market.
Makes sense.
They're also developing Galileo to be a global payments backbone, maybe expanding into Latin America or Europe. And of course, AI-powered financial planning and small business banking are high on the list.
You know, this whole journey, it all comes back to that one simple question from Stanford. It really reiterates a fundamental truth about financial innovation.
It does. SoFi's story proves that the future belongs to companies that understand people and their potential, not just static numbers from the past. Where traditional banks saw complexity and risk, SoFi engineered simplicity, data efficiency, and trust. They built a financial institution for the digital age.
So let's leave our listener with a final thought to think about.
Okay, so given SoFi's unique combination, a full U.S. banking charter and owning the payment infrastructure with Galileo, what is the next big profitable area in American finance beyond consumer lending that this deeply vertically integrated model is now best positioned to revolutionize? If they can control the cost of money and the speed of transactions, what old barriers can they now just bypass for the first time? That's the real challenge facing the incumbents now.